Welcome to our weekly roundup of key economic and business developments in Sri Lanka. I'm Nishani Figuera, and here are this week's top stories. Domestic debt restructuring deadline extended for the third time. Banks want to reduce interest rates. Sri Lanka launches 1.6 billion rupee global tourism campaign. In our main story this week, on Monday, the deadline for Treasury bond holders to submit offers to exchange their rupee-denominated bonds for new rupee Treasury bonds was extended. The third extension is now to close on the 11th of September. This was needed to allow for restructuring the Employee Provident Fund, the country's largest social security fund, which has encountered significant opposition. Among the main objections is a low interest rate on offer for member balances and high tax rates proposed under the reform program. However, despite being extended for the third time, domestic debt restructuring program is likely to be completed before the first IMF review, slated to begin on the 14th of September. The central bank issued an ultimatum to banks to reduce interest rates. It stated that rates on new and existing rupee-denominated loans, excluding select credit facilities, should be reduced by at least 250 basis points by the 31st of October and a further 100 basis points by the 31st of December this year. This is in comparison to the interest rates that prevailed as at 31st July 2023 and does not apply to facilities already charged 13.5% or lower. The regulator had previously noted that it observed market interest rates on certain lending products are still excessive and not in line with the current monetary policy stance. Sri Lanka's exports in July continue to trend lower, falling 11.9% from a year earlier. Trade during the first 7 months is now down 10% from the same period last year. This is due to the economic slowdown in Sri Lanka's main markets, the United States and the United Kingdom, which fell 15% and 22% respectively. Encouragingly, exports to India were up by 29%. According to the EDB, services exports during January to July 2023 was $1.22 billion, an increase of 17.3% year over year. In April, the Export Development Board set a target of $15.9 billion for merchandise exports for the year. Given that only $6.9 billion has been achieved so far, the full year estimate seems challenging. The Cabinet approved the elimination of simplified value-added tax. Introduced in 2011, SVAT allowed for imports of inputs for export goods to be exempt from VAT, avoiding delays in VAT refunds. According to the IMF's extended funding facility conditions, changes to the VAT include elimination of exemptions and discontinue SVAT. However, exporters significantly oppose this move, citing that their cash flows would be impacted as there will be long delays, inefficiencies and misuse in settling VAT refunds by the Inland Revenue Department. During the first 27 days of August, 123,285 tourists arrived in the country. This pushed the year-to-date visitor numbers to just over 891,000, 24% higher than last year's full 12-month arrivals. However, daily arrivals in the month continue to fall, recording at only 4,566, down from the over 5,000 early August. A target of just under 150,000 has been set for August, with Kandy Perahera and Asia Cup expected to drive arrivals higher. Arrivals from India continue to increase at a steady pace and are now at almost 21% of month arrivals. Now let's take a look at the weekly movement of the All Share Price Index and the S&P SL 20 Index at the Colombo Stock Exchange. At the Treasury bill auction held on Tuesday, yields on all maturities expanded for the second consecutive week. Bids amounting to 219 billion rupees were received, of which 108 billion were accepted. The Sri Lankan rupee was steady against the dollar this week, with the central bank's indicative mid-spot rate ranging between 322 and 323. And with that, we wind up for this week. Do subscribe to our YouTube channel at the link below for regular updates on economic and business developments in Sri Lanka. Until we see you again next week, thank you for watching. Stay safe.